You know, um, I often tell my older friends this. In investing, just like in life, it's not about how fast you go, but whether you're safe enough to go the distance. And every time the market enters a shaky, unpredictable phase like we're seeing now, I'm reminded of an uncle of mine who lives out in California. He's the kind of man who has been through every financial storm imaginable, yet still carries this calm, almost unshakable peace about money. He once told me, money is hard to build, but it disappears in a heartbeat if you don't have principles. And that's exactly what I want to share with you today. Before you put a single dollar into the market, whether you're 30 or 70, you need a set of survival principles, not theories, not fancy advice, just real lessons I've learned after working with thousands of investors, including retirees and seniors, living off the savings they built over a lifetime. I always tell them, let your money breathe. Don't put it somewhere that keeps you up at night. Because the market today is not as easy as it was a few years ago. You may have noticed money is leaving many industries that were once considered stars. Banking, brokerage, real estate. The sectors that dominated for so long now feel like they're running out of steam. Part of it is policy, but part of it is simply that the market has matured. It wants real quality, real earnings, not inflated promises. I get emails from older viewers telling me the market feels harder to read. But the truth is, the market isn't confusing. It's actually very clear. Sharp. The only problem is that sometimes we don't want to look directly at the obvious. For example, have you noticed this? When bank interest rates rise to around 6 to 7%, the stock market has to offer something significantly better for investors to take on extra risk. But right now, the market's expected return, based on what we call the P/E ratio, is only around 7%. A bit higher than the banks, yes, but not enough to help you sleep peacefully at night when your money's on the line. A colleague of mine in New York once told me, a truly attractive market should pay you at least double what the bank pays. And I think that's especially true for people in midlife or retirement, when safety and stability matter more than anything else. So when I say the market no longer offers easy opportunities, I'm not trying to scare you. I just want you to see what the numbers are quietly telling us. Money is leaving financial sectors and flowing towards safer, more fundamental businesses. Companies that actually produce things, earn real profits, generate real cash flow, and offer returns around 9 to 10%. But don't misunderstand this. High yield doesn't mean high growth. This is something I really want you to grasp. Manufacturing and industrial companies often have clear limits to their growth. Capacity constraints, production ceilings. They only surge when they open new markets or expand factories. Otherwise, their stocks tend to rise for a few sessions and then settle down again. I'm telling you this so you don't expect dramatic short-term gains, because the faster something rises, the faster it tends to fall. Anyone who has lived through a few market cycles knows exactly what I mean. One of my 68-year-old viewers from Florida told me that the market feels like a stage where the spotlight always shines on the noisiest corner, but real value stays in the shadows. I told him, you're right. Smart money doesn't chase noise. It follows real profits. And right now, real profits are sitting in companies with 10 to 15% dividends, steady operations, low cyclicality, and very little chance of swinging from big profit this year to huge loss next year. Because as we mature, in life and in investing, we stop chasing drama, we start looking for peace. And I believe that whether you're 35 or well past 70, you want the same thing. A portfolio that doesn't wake you up at 2 a.m., but there's something you absolutely must remember, something many people forget. Every investment decision must be tied to your personal financial situation. There is no single piece of advice that fits everyone. Someone with strong cash flow will invest differently from someone living off a fixed amount. Even if two people watch the same video and hear the same analysis, they will and should end up making different choices. That's why in today's conversation, I'm not telling you what to buy or sell. I just want to give you a clearer pair of glasses so you can see the market with more honesty, more awareness, and fewer illusions. So you can make decisions that match your financial reality and your life rhythm. Because in the end, investing isn't a game of luck. It's a journey toward peace of mind. And I'm here to walk that journey with you. As we go a little deeper, I want you to take a few seconds and ask yourself, what truly creates the value of an investment? It's not rumors. It's not those sudden, explosive price spikes. And it's definitely not shiny promises about a brighter future. Real value is created by real cash flow. And that's exactly why the market has become difficult for many sectors right now, especially banking and securities. These industries rely heavily on the heartbeat of the entire economy, on the speed of money circulation, and on the excitement of investors. When the market slows down, when interest rates rise, when safety margins shrink, they naturally become the vulnerable ones. I remember a conversation with a fund manager in Chicago. He told me something that sounded simple but carried a lot of weight. When margin is tight, the market can't explode. He was right. New regulations are requiring brokerage firms to lower lending limits and reduce leverage. That means the amount of sensitive money, the kind that can push stock prices up quickly, is slowly disappearing. Some viewers ask me, is this a bad sign? I usually smile and say, no, this is just reality coming back. No economy can depend on leverage forever. A healthy market must rely on real, sustainable growth, not borrowed fuel. And when borrowed fuel dries up, something becomes very clear. The truly strong businesses will stand firm. The ones that only look good on the surface will start showing cracks. What's interesting is that in this environment, money is flowing toward a direction many used to call boring: manufacturing companies. Someone once asked me, why are manufacturing stocks attracting money if they're not exciting? I usually answer with another question. Do you want adrenaline or do you want to sleep well? Manufacturing companies don't promise explosive growth. They don't paint grand, glowing visions. They do one thing and they do it well. They generate real, steady, consistent profits. And that's exactly what attracts the smartest money. You may be surprised to know that some manufacturing companies are offering returns of 9 to 10%. Banks are paying around 6 to 7%. In the brokerage sector, the one once treated as a gold mine is offering an earnings yield of just 4%. If you're a 60-year-old investor nearing or already in retirement, what would you choose? A stable 10% return or 4% from a business that depends entirely on market volatility? Sometimes the answer is right in front of us. It's just that we tend to complicate things more than necessary. But I want you to understand something important. High yields don't always mean the stock price will rise sharply. Manufacturing companies are often limited by their own production capacity. They can't suddenly break out unless they expand their factories or enter new markets. So their stock prices move at a very human pace, slow, steady, and sometimes a little sleepy. But in investing, sleepy isn't bad. Sleepy means safe. It means you don't have to check your portfolio every morning. It means you have time for your family, your friends, or for yourself. And if you think about it, you'll realize this. As we mature, we learn to appreciate the simplest things: stability, consistency, durability. These companies are like a friend you've had for 30 years. Someone who doesn't talk much, doesn't make big promises, but always shows up when you need them. And sometimes that's more valuable than any miracle. But to choose these businesses correctly, you need a bit of knowledge about valuation, not academic theories, just the basics. For example, what is P/E? If you're used to earning 6% a year in a savings account, then the stock market is only worth your risk when it offers 12 to 14%, which translates to a P/E of about 7 to 8. That's the minimum return to justify taking on market risk. But right now, the market average PE is around 14, meaning an earnings yield of roughly 7%. That's about the same as the bank. Not nearly enough to make someone age 60, 65, or 70 feel secure. This is why I always say, don't rush. When a market isn't attractive, you shouldn't be in a hurry. It's like driving on a foggy road. That's when you slow down. Nothing is worth risking more than necessary. I remember an older gentleman once asked me, so should I pull out completely and stay out of the market? I told him, no, don't stand outside the market. Stand somewhere safe inside the market. And the rest, the most important part, is learning how to choose that safe place. In the next section, I'll go deeper into which factors help you identify a stable, sustainable business, what dividend levels are worth considering, and how to avoid cyclical stocks that can turn your finances upside down in just a few months.